NIO just filled the tank with fresh capital, $1.16 billion. Underwriters took the full allotment. UBS flipped to buy with an 850 target. August set a company delivery record. The question that moves real money right now is simple. Does this cash turn momentum into a true breakout, or does it only buy time? Tap subscribe and let's make this decision clean. The company officially completed a $1.16 billion equity offering, and underwriters fully exercised the option for additional ADSs. NIO told investors the proceeds are earmarked for core research and development in smart EV technologies, expansion of battery swapping and charging infrastructure, development of future vehicle models, and general corporate purposes. That is not just a balance sheet patch. It is a roadmap for where the next phase of growth is supposed to come from, with enough liquidity to execute without starving operations. 2 days later, the narrative picked up another tailwind. UBS upgraded NIO from neutral to buy and lifted the price target to $8.50, citing stronger sales potential from the newest models like the L90 and improved financial visibility after the raise. The note explicitly ties product traction to a healthier balance sheet, which is exactly the pairing long-term investors want to see. Multiple outlets captured the upgrade and the logic behind it, and the stock responded with a fast push toward recent highs. There is real demand showing up in the operating data. On September 1, the company reported a record 31,305 vehicles delivered in August, with momentum spread across the premium NIO brand, the family-focused Anvo line, and the emerging Firefly segment. That kind of volume sets a higher baseline heading into the fall launch calendar, and gives management more room to drive scale benefits through the income statement. A capital raise only creates value if it accelerates the path to self-funding. The single line that decides whether this offering becomes a breakout is the relationship between gross margin and the growth spend it enables. If battery swap expansion, new model launches, and smart EV R&D push volumes higher without crushing unit economics, the equity raise compresses the time to sustainable free cash flow instead of diluting it. NIO's stated use of proceeds is aimed right at the bottlenecks that can unlock scale. That is why this raise is different from a defensive top-up. Now tie that to what the street just said. UBS did not make a sentiment call in a vacuum. The upgrade leans on a product cycle that is finally catching a bid, and it flags a balance sheet that looks sturdier after the raise. Put simply, the bank thinks execution can meet the market where the valuation wants it to go. You still need proof quarter by quarter, but the setup improved meaningfully. The record August deliveries are not a trivia stat. They are a stress test of 3 levers at once. First, model mix. Premium SUVs like the ES8 bring brand strength and pricing power, while Anvo's L90 is designed to pull share in the mass market. Second, infrastructure. Battery swapping is only a moat if stations are dense enough for daily life. Scaling that network is exactly where part of this fresh capital is headed. Third, pace. A record month is great. Sustained records are how you move a stock from range-bound to trending. Earnings rhythm reinforces the point. Management just confirmed the September 2 second quarter report schedule, then followed with the August deliveries release on September 1, then closed the equity offering completion 2 weeks later. That cadence matters. It shows a company moving from story to execution, which is what institutions demand after a capital raise. Near-term price action will live at the intersection of 2 forces. On one side, you have a stronger balance sheet, improving operating data, and a big bank leaning bullish with an 850 target. On the other, you have dilution math, a still competitive China EV market, and macro headwinds from yields that can compress multiples. If you simply plot price against that new target, there is visible room above spot. The breakout case is not about a number on a note. It is about whether the margin line bends up as volumes push higher into year-end. Here is the clean way to think about it. Use the raise as your risk anchor. If over the next 2 quarters we see battery swap density improve, L90 and the 3-row ES8 drive consistent orders, and gross margin trend back in the right direction, the stock has permission to trade closer to the analyst cluster in the 8s and potentially test the 9s cited in broader target surveys. If any of those pillars crack, the market will fade exuberance quickly and revisit the mid-6s to 7s where skeptics feel comfortable. Keep your focus on what converts headlines into value. Watch the delivery run rate into October. Watch the station build-out pace where swapping is expanding, and listen for management to tie cash from the raise directly to cost per vehicle and station unit economics. The more direct the linkage, the stronger the case that this raise was the springboard, not a bandage. The upgrade cycle is turning. UBS moved to buy with $8.50. JP Morgan reiterated its $8 target and highlighted improving product momentum. Aggregators show average targets still clustered below the highs, which means every incremental operating win can re-rate the name because expectations are not stretched beyond reach. That is a favorable position for a stock coming off a record month and a completed raise. At the same time, day-to-day tone can still swing on options flow and macro nerves. Short-term headlines flagged mixed options activity even as shares tested resistance, which is typical when a stock is deciding whether to break out or build a base. Use that churn to your advantage by keying on fundamentals rather than letting noise shake you out of a plan. Before we continue, if you've been following this channel, you know I don't waste your time with hype or guesswork. I focus on research, real insights, and tools that can actually help investors. That's why I've partnered with The Motley Fool, one of the most trusted names in the investing world for over 20 years. You'll find my link in the description. Is the easiest way to check them out and see what they offer. That link also gives you access to special deals or discounts they have available right now. And yes, it helps support the channel too. Now let's get back to the video. If you are building a position, scale around proof points. The company just delivered a record month. It just closed a fully subscribed equity raise with a green shoe exercised. A top bank turned buyer with a higher target. Those are objective supports. Add to that only if management shows that new capital is moving margins and infrastructure coverage in the right direction. If you are already long, center your hold or trim decision on the next two updates. Strong September and October delivery prints with clear capex cadence make holding rational. Any backslide on volume or a muddled use of proceeds argument is your cue to lighten and revisit after the next checkpoint. This is what changed. NIO took in $1.16 billion, told you exactly where it is going, and immediately earned the buy from UBS with an $8.50 target. August deliveries hit a record and the product set finally looks like a lineup, not a pitch deck. That is how real breakouts start. It is not guaranteed, it is earned with execution. If the next stretch proves that cash became capacity and capacity became profitable growth, calling this the last cheap entry will not sound dramatic, it will sound obvious. This is it for this video guys, thanks for watching and please make sure to subscribe, like and leave a comment down below.